tax considerations for passive income streams. Taxes on income are a fact of life. They are paid for the majority of working persons' lives. Therefore, it is crucial to comprehend what your tax liabilities are. One of the most typical tax-related queries we receive at CMP is this one: are taxes on passive income need to be paid? The tax on passive income might occasionally confuse people. The tax laws governing passive income are reviewed, the tax advantages of passive income are discussed, and all the information you need to calculate and pay taxes on your passive income is provided in this article. Passive income tax. What is it? Active income is money you receive in exchange for doing work. You receive payment for your labor, also known as active income, whether you operate a business, work for an organization, or work on your own. In contrast, passive income is cash you receive without actively working. The interest you receive on a savings account is a relatively straightforward example. Even though you didn't labor for the money, it is still regarded as income. The same holds for rental revenue and dividend payments. The tax you pay on income derived from sources other than your primary employment or money-making side hustles is known as passive income tax. If your pastime earns you money, it is not passive income because you must put in the effort to earn it. True passive income is money you earn without working. The mechanism of passive income. There are several ways for people to generate passive income, some of which have already been addressed. Interest from a money market account is considered passive income. If you run a website that shows advertisements and gets paid when users click on the advertisements, you might also generate passive income from it. What you do to earn an income is the main distinction between passive and active income. It is passive income if the response is nothing. Even while you're sleeping or on vacation, you can still make passive income. Even though you may have put some effort into developing passive income streams, once they are in place, there is no work involved in receiving the cash they produce. What advantages do passive income offer? Earning passive income has numerous advantages, some of which are tax advantages. Passive income is fantastic for your finances since it allows you to make more money than you could from your job without putting in more effort. You can increase your annual income and raise your level of life if you save money or purchase stock that generates dividends. From a tax perspective, there are a few advantages to take into account. Most are related to rental property tax on passive income. Although the money you get as rent is theoretically subject to ordinary income tax, you can lower your effective tax rate by deducting depreciation, amortization, and rental costs. Later on in this essay, we'll talk more about these deductions. Taxes on passive income. At CMP, we frequently get the inquiry about whether passive income is subject to taxation. Some people mistakenly think that they only have to disclose the income that is shown on their W-2 form, which might get them into difficulty with the Internal Revenue Service and state taxing authorities. The short answer is that until tax legislation specifies otherwise, all income is taxed. It doesn't matter if you derive your income from a dividend or interest paying account or from the work you do every day. That income must be reported to the IRS and taxed accordingly. But the solution is also trickier than you may imagine. Although indeed, active and passive revenues are frequently taxed at the same rate, there are several exceptions. It is safe to assume that most passive income is taxed at the same rate as active income, which is the regular tax rate. To make sure you disclose everything, tax planning for passive income should involve an itemization of sources. What is the passive income tax rate? What is the IRS's rate on passive income? The most straightforward explanation is that passive income is often taxed at the ordinary income tax rate. The ordinary income tax rate is the most prevalent, as its name suggests. The money you make from your job and any side jobs you may have is used for active income. Let's look at an example to give you an understanding of how passive income may be taxed and what the rates are. Federal income taxes would be paid by a single person with an adjusted income of $90,000 in 2020 for $15,686. This amounts to about 1,743% of the total. Additionally, if that person received $1,000 in ordinary dividends, those would also be subject to taxation at the standard rate of 17.43%. The same is true for interest from a money market account or interest from a bank. What occurs with income from real estate is one distinction. A rental property depreciates 27 to 39 years after the acquisition, while the income is taxed. Depreciation and amortization might help you reduce your effective tax rate. For instance, if you received $20,000 in rental income but only had to pay taxes on $8,000 after deducting $12,000 for depreciation and amortization, the total tax you would have paid on such income, even if you had used our example's regular tax rate of 1,743%, would have been $1,394.40. The effective tax rate on such income is only 6.97% when compared to your real income of $20,000. The taxation of passive income. The procedure of paying your taxes can become more challenging if passive income is reported. Before filing your taxes, you will receive several documents if you have a sizable passive income. You must keep records for various types of income, such as real estate revenue, to declare your earnings to the IRS. Here are a few tax forms you might get or need to fill out to calculate your taxes on passive income. Banks and other financial organizations record dividend income by using Form 1099 DIV. Interest income must be reported using Form 1099 INT. Rental property income is reported on Schedule E, Form 1040. Is passive income taxable as self-employed income? Whether the money you get from passive income streams is subject to self-employment tax is another often asked topic about passive income tax. The employer and employee contributions to Medicare and Social Security taxes are included in the self-employment tax rate, which raises the effective tax rate for independent contractors compared to employees. The following are included in self-employment income, according to the IRS. Money that you make as a sole entrepreneur or independent contractor from a trade or business that you own. The money you make from a partnership that operates a business or commerce. The money you would normally make running your own business, including from part-time employment. You'll see that these criteria omit payments for dividends, interest, and rental revenue. This means that even if you must pay taxes on your passive income according to the IRS definition, you are exempt from paying the self-employment tax on it. Tax-related examples of passive income. Let's look at some examples of passive income for tax purposes so you can better grasp it and how it will affect your income taxes. It's important to understand what constitutes passive income, and whether you must report it to the IRS and your state revenue authority. The following are a few of the most typical types of passive income. Income from rental properties. The IRS counts the money you receive in rent if you own rental properties as passive income. Although the regulations can be complicated, in general, you must disclose your income as soon as you receive it. The following is included in this: rental properties income. If you own rental properties, then the money that you collect as rent is counted as passive income by the IRS. The rules can be complex, but generally, you need to report your income when you earn it. Real Estate Investment Trust, REITs. Real estate investment trusts, or REITs, are investment vehicles modeled after mutual funds. The primary difference is that instead of investing in stocks and bonds, REITs own and operate real estate used as rental properties. A bond ladder. Bond ladders are bond portfolios featuring bonds with different maturity dates. As an investment strategy, bond ladders are useful because they diversify your portfolio and spread out both income and risk. We appreciate your viewing, and we hope you enjoyed the video. How was the video? Did you enjoy it? Post your feedback in our comment section below, and subscribe to our YouTube channel Project Ventive for more updates.